Hello, I'm Rafael Castro and I'm here with Francesco Cowley and Gustavo Teller, the speakers for a recent webinar we hosted on the topic of infrastructure finance, assessing risk and opportunity in a changing market. During the webinar, we discussed key trends in the market, such as the rise in shadow banking and general investor concerns over construction risks. We also talked about best practices for assessing credit risk for infrastructure projects. We received lots of questions from our online participants, including some that we weren't able to answer during the live event, which we'll answer now. Firstly, Gus. Now, it's under the understanding that banks form syndicates to distribute lending risk. How do investors go about looking at risks from an equity perspective?
So there's several ways to address that, right? So the first one is that they're going to be looking to create SPVs, the sponsors, together with the constructors and the operators, right? Then the other thing that is very important from a risk perspective is understanding the complexity of the deal. So the risk and return, depending on the structure of this project finance, are going to have a direct impact, again, on the assessment of risk. And then finally, there's going to be some contractual terms that would help you mitigate some of that risk, right? So for instance, when we're talking about construction risk, it's very likely that you're going to try to put in place a fixed price contract, right? Again, to control your construction costs. From an operation perspective, you can create operation adjustments that is tracked to or linked to a benchmark, an inflation benchmark, to protect you from depreciating levels of the currency through time. And then finally, another way of mitigate risk is to look from revenue generated on an availability basis rather than a usage basis. Again, the contractual angle is facilitating you to mitigate that risk a little bit. And then needless to say that you probably would want to have a very good understanding of the off-takers and the revenue providers that are going to be involved in that project, so you feel comfortable from a credit angle that they will be there and they will be able to deliver what they promised. And finally, the legal framework that governs that project finance in question needs to be fully understood in order to have a full understanding of the risk surrounding the project there, right?
Thank you, Gus. Now, staying with risk management, but over to you, Francesco. We had a few questions around evaluating the different sectors in infrastructure. How would you describe the risks within the different sectors?
Sure. Well, first of all, let me start by saying that most of the key risks present in project finance transactions are pervasive in all sectors. What essentially varies is the level of protection that each sector can provide. So some of the main risks associated to project finance, and they have been, I would say, they have been able to allow us to predict defaults and downgrades, regard competitiveness deterioration, country and sovereign risk, contractual risks, counterparty risks, namely the risk of a revenue provider credit quality deteriorating, and so on. All these aspects will have a different importance whether you're looking at a certain point in time, at a certain sector, or at a different geographic allocation. When we look now more into the details of the sectors that compose the infrastructure industry as a whole, I would start by the renewable energies sector. What we've experienced here is that regulatory risk still remains an important aspect, especially for solar photovoltaic projects located in countries that are facing economic downturns, or such as Spain, or countries that are facing unproven regulatory frameworks. In those countries, what is being essentially tested is the sustainability of the granting system to this form of energy generation. With regards to wind farms, here the main problem has been associated with the variability and unpredictability of the resource. It's very difficult to estimate with accuracy wind for long term. So we have seen many projects that have overly optimistic wind forecasts, and furthermore also operational costs maintaining the turbines, namely, have been higher than expected. When we look at transportation, here the main focus, I would say, is in between demand and price risk. In Europe, most of price risk has been highly mitigated by inflation adjustments, so that's less of a concern for investors. What remains is, in these projects that are exposed to volume risk or market risk, is the fact that traffic as well is very difficult to predict over the long term, especially traffic growth, and it can experience very sharp decreases following economic downturns or the creation of competitive alternatives. When we look at PPP, PFI sector, This is probably the one that has been more protected from this risk because it is generally created on an availability base, meaning that revenues and quantities are guaranteed. Nonetheless, in this sector, it is very important the relationship between the public counterparty providing the revenue and the project itself. We've seen some downgrades due to disputes and between these two counterparts. I would say then that construction risk remains an important aspect to be considered for all projects, regardless of the sector. So whether you're looking at building a complex power plant, bridge, tunnel, and infrastructure, or a simple accommodation project, it's not a risk that should be overlooked. Because of the nature of project finance, that is usually long-term, so the maturities in project finance range from 10 to 20 years, I would say it's safe to assume that no project will be shielded for the whole amount of time from all these risks or from some of these risks. That's why we recommend as a best practice to assess the project on a case-by-case basis and not overlook the risks because they usually were not present in this sector.
Thank you, Francesco. Now, Gus, moving slightly away from a purely risk management perspective and looking more at the portfolio management aspect side of things, how do investors go ahead and look at the sizing of investments in infrastructure?
So that's a very good question, and at the same time a very tricky question because there's no right or wrong, right? So we can start by saying that the diversification benefits of investing in a different asset class, it's key for any portfolio that is considering risk. So a couple of things come to mind. First thing to consider is the fund's mandate that you already have in place. So depending on the mandate and the risk and return objectives that you already have in place, maybe a project finance might be constrained or not be an option at all. Having said that, you can also look at existing concentrations, such as sector concentration and country concentration, right? But then again, the important thing to remember is that it has to be from a reasonable size, the investment that you're going to put into a project finance deal, right? So if you're looking at a £5 million investment, it's probably going to take as much effort and manpower as if you're investing £150 million in the same deal. So of course, those two scenarios are going to have very different payoffs in terms of risk and return.
Thank you, Gus. Now, Francesco, we talked previously about risk from an equity perspective. Our next question is about bonds. It was only very recently that S&P Ratings gave its preliminary rating of a BBB to the first Europe 2020 Project Bond Initiative, the Watercraft Credit Enhanced Project Bond. What do you think is the future of project bonds in EMEA?
Well, with several governments implementing austerity packages and the contraction that we're experiencing at the moment of the banks lending to project finance, the European Union sees a need for attracting other private investors and capital markets for the funding of large-scale infrastructure projects. In order to do so, it has proposed two mechanisms. The first is the provision of a debt service facility that will be available throughout the life of the project to cover senior debt shortages. The second is the provision of a subordinated loan at the beginning of the project, and that will namely serve to finance the construction of the project or any refinancing risk attached. In practical words, what the initiative tries to do is to allow infrastructure projects to achieve this A rating category that would make the bonds or the project finance bond market much more liquid, which is the need that the market sees now for infrastructure financing. Given said that, Project Watercraft consists in the construction and operation of an oil and gas storage facility in the coast of Spain. It is the first project to benefit from the European 2020 Project Bond Initiative, as you correctly said, and it has achieved a rating of BBB, which is one notch higher than the rating of the sovereign, partly thanks to that guarantee that it has received from the European Investment Bank in the form of a 200 million debt servicing facility, million euros, by the way. What is the future in EMEA? Well, we are still under the pilot phase of this initiative. The pilot phase will comprise financing in the next years from 7 to 10 projects. It's still uncertain and difficult to predict what will be the reaction of the market to this initiative and what will be the success that it obtains in achieving these A ratings. And for instance, one important thing to mention is that rating agencies do not look only at this type of credit enhancement as the sole factor that would allow a project to achieve an A rating. If a project is weak, it will not be prevented from be downgraded or from being rated lowly despite having this guarantee. On the other hand, the markets are seeing a very strong political institutional commitment from the European Union to fund infrastructure and to support it, and this could boost confidence, especially to new entrants. The more new entrants you have, the more liquid the market becomes, and that could be a positive future. I would say it's safe to assume that for the moment, this initiative is likely to attract investors in projects that are either existing, therefore have a better visibility, past visibility, or in availability-based projects that are generally perceived to have a lower risk.
Okay, thank you. That's all we have time for today. So thank you, Francesco and Gustavo, for answering these questions, and thank you to the audience for tuning in. For more information about S&P Capital IQ and to see what webinars we have coming up, please visit www.spcapitaliq.com.